If you are a homeowner age 60 or older, what I'm about to share could quietly put thousands of dollars back into your pocket or quietly strip benefits away without you noticing. On July 4th, 2025, a sweeping new law called the One Big Beautiful Bill Act was signed into law, and it changes the tax rules, the benefit rules, and the property tax landscape for millions of senior homeowners across America. Some of the changes are genuinely good news, and the federal government has begun calling it a tax break designed for seniors. But hidden inside this same law are strict income limits, a 4-year expiration, and other provisions that could slowly raise the cost of living for seniors who own their homes. Some homeowners will pick up a new deduction worth up to $12,000 for a married couple. Others will earn $1 over the limit and receive nothing. And many seniors will be surprised to learn that the biggest benefits quietly pass them by. Stay with me, because I will explain who actually qualifies, who quietly gets shut out, what to do before the next tax filing season, and the warnings that could cost you hundreds or thousands of dollars if you simply do nothing. If this kind of clear information helps you and the seniors in your life, tap the like button now. It tells the algorithm to show this video to more people who need it. Subscribe to the channel and turn on notifications so you do not miss the next big update. And leave a comment with your city and state, because local property tax rules vary widely, and your neighbors often share information that helps everyone watching. Let us start with the single biggest change every senior homeowner needs to understand. The One Big Beautiful Bill Act, often shortened to OBBBA, created a brand new federal tax deduction stacked on top of the standard deduction older Americans already receive. According to guidance from the Internal Revenue Service, effective for tax years 2025 through 2028, individuals age 65 and older can claim an additional $6,000 deduction on their federal income tax return. If both spouses in a married couple are 65 or older, the deduction rises to $12,000 combined. In simple terms, the federal government is reducing your taxable income by up to $12,000 per household, which translates directly into a smaller tax bill or a larger refund. Picture a retired couple earning roughly $40,000 a year from Social Security and a small pension. Before this law, they might have owed a few $100s in federal tax. With the new senior deduction, they could end the year receiving a refund of several $100s instead. That is real money and real relief. But here's the part that makes this headline both exciting and dangerous for homeowners age 60 and older. The deduction has 2 strict rules that catch many people by surprise. First, while viral headlines say 60 and older, the federal version of this deduction is officially reserved for taxpayers age 65 and older. If you are 60, 61, 62, 63, or 64, you do not yet qualify for the $6,000 federal deduction on its own. That does not mean you are out of luck. Many states and counties run their own senior property tax exemptions that begin helping homeowners at age 60 or earlier, and I will explain those layers in a moment, because the interaction between federal rules and local rules is where most seniors quietly lose money. Second, the deduction phases out based on your modified adjusted gross income, which is essentially your total income before most deductions are applied. If you file as a single person, the deduction begins to shrink once your modified adjusted gross income goes above $75,000, and it disappears at higher income levels. If you are married and filing jointly, the phase-out begins at $150,000. This figure includes your Social Security benefits, your pension, your withdrawals from retirement accounts, and most other taxable income. So a comfortable retired couple who owns their home free and clear, who collects Social Security, who draws income from a 401k or an IRA, and who receives a small amount of investment income, may quietly float above the $150,000 ceiling and miss the deduction entirely, even though they believed it was meant for them. This is where the bad news framing becomes real for millions of homeowners. The deduction is genuinely real, and the Internal Revenue Service has confirmed it. But it is not the universal senior relief program that some headlines suggest. It applies only to qualifying taxpayers. And if a senior does not carefully review their projected 2025 income before year-end, they may take a withdrawal or accept a cost of living adjustment that pushes them above the line without realizing it. Before we go further, I want to make sure this video reaches every senior homeowner who needs to hear it. If you know a parent, grandparent, neighbor, or friend who owns their home and is 60 or older, please share this video with them today. Many seniors do not watch financial YouTube channels on their own, and a single share could save someone in your life thousands of dollars. Like the video, subscribe if you have not already, and leave a comment with the word shared if you have sent this along to someone you care about. Engagement is what lets these videos find the next family that needs them. Now let us move from federal taxes to something that affects far more senior homeowners in a more visible way: property taxes. No matter what the federal government does in Washington, your home still sits on a piece of land inside a county or city that sends you a tax bill every year, and that bill has been climbing faster than inflation in many parts of the country. This is also where the age 60 threshold truly matters, because most senior property tax relief programs at the state and local level begin helping homeowners at age 60, 61, or 65, depending on where you live. Across the United States, there are 4 main types of senior property tax relief programs, and most homeowners age 60 and older qualify for at least one of them, even when they had no idea it existed. The first is the homestead exemption, which reduces the taxable value of your primary residence. In some states, the exemption is small. In others, it removes tens of thousands of dollars from your taxable value, dropping your actual tax bill by hundreds of dollars or more every year. Many states automatically apply homestead exemptions to seniors, but some require an application, and missing the filing deadline is one of the most common ways senior homeowners overpay their property tax bills for years. The second is the circuit breaker program, which gives you a credit on your income tax return when your property taxes exceed a set percentage of your income, preventing a huge tax bill from squeezing a household that does not have a large income. The third is the property tax deferral program, where the state lets you postpone paying your property taxes with interest until you sell the home, until you move out, or until you pass away. This keeps cash in your pocket now, though it creates a balance that grows slowly. And the fourth is the assessment freeze, which locks the taxable value of your home at the value it had when you became eligible. So your property tax bill does not keep rising simply because the county reassessed your property at a higher number. Here is why July matters so much. Many states and counties set their property tax exemption and deferral deadlines around the middle of the year. Some deadlines fall on July 1st, some on July 15th, and some on July 31st. Other deadlines depend on when your new tax bill is mailed and require action between that mailing date and a fallback date later in the summer. If you are a senior homeowner who has never applied for the senior freeze, the senior property tax exemption, the homestead exemption for seniors, or a deferral program, the window between now and the end of the summer is often your last clean chance to lock in savings that you would otherwise lose for the rest of the year. If you refinance, if you transfer the title to a family member, if you change your primary residence status, or if you simply forget to reapply after a move, that confusion can quietly cost you an exemption you thought you already had. So the practical first step is this. Pull out your most recent property tax bill, look in the top corner for your parcel identification number, and call your county assessor's office. Ask them, in plain words, what senior property tax relief programs you qualify for based on your age, your income, and how long you have lived in the home. Ask whether you are already enrolled. If you are not, ask what paperwork is needed and what the actual deadline is for the current tax year. Some states let you apply at any time and still receive a future credit. Many states do not. Many require you to apply during a narrow window tied to the spring reassessment cycle and the summer tax billing cycle. Missing that window often means waiting an additional full year for the savings to start. Now here's the part the headlines rarely cover. The same One Big Beautiful Bill Act that introduced the new $6,000 senior deduction also made changes some financial advisors quietly warned could affect senior homeowners in less welcome ways. The new law trimmed or eliminated several clean energy credits that were popular among homeowners, including credits tied to residential energy efficiency upgrades, heat pumps, solar installations, electrical panel upgrades, and certain window and insulation improvements. For senior homeowners planning to renovate their home to lower monthly utility bills, the federal tax credits that previously offset part of the cost are smaller now or gone entirely. The law also tightened home office deduction rules in ways that can affect seniors who run a small home-based business or consult part-time after retirement. If you have already started a renovation project this year or have signed a contract with a contractor, talk to your tax professional before you spend another dollar, because the credit may no longer apply and the price you pay out of pocket may be higher than you expect. That is the kind of quiet cost increase that rarely makes headlines, but it hits senior homeowners when they want to age in place and lower utility bills at the same time. We are covering a lot of ground, and I want to make sure you can come back to this information when you need it. Smash the like button if this video is helping you plan your next move, subscribe so the next big update finds you first, and leave a comment with your age range, whether it is 60 to 64, 65 to 70, or 70 plus. Your input helps me shape the next video around the exact concerns of the people watching right now. Now let us pull all of this together into a clear action plan. The first action item is about your federal taxes for 2025. If you are 65 or older, confirm your projected modified adjusted gross income for the full year of 2025. If your income is comfortably below $75,000 as a single filer or $150,000 as a married couple, you can plan to claim the new $6,000 deduction on the return you file in early 2026. If your income is hovering near those limits, talk to a tax professional before year-end about the timing of your retirement account withdrawals, your Social Security claiming strategy, and any capital gains you may be considering. A small shift in timing can keep you inside the deduction window and save you real money. The second action item is about your property tax. Open your county assessor's website, look up your parcel, and check whether every senior relief program your county offers is already showing on your record. If anything is missing, call the assessor this week. If the deadline for this year's application has already passed, ask whether you can pre-qualify or pre-apply for next year so you do not miss the window again. Many counties also let senior homeowners request a formal review of their property's assessed value, and if your home value was raised in the past year even though you made no improvements, that is a strong sign it is worth filing an appeal. The third action item is about your Social Security and Medicare coordination. Many senior homeowners make decisions about when to claim Social Security based on the size of the monthly check alone, but the new senior deduction, the income phase-outs, and the way Social Security is treated in modified adjusted gross income all interact with one another. A quick conversation with a qualified advisor can put hundreds or thousands of additional dollars back into your household every year. The fourth action item is about your renovation plans. If you were counting on a residential energy credit to reduce the cost of a home improvement, stop and check with your tax advisor before signing new contracts or making new purchases. Some credits were preserved at lower levels, some require action by a specific date this year, and some were eliminated. The fifth action item is about your estate and home title. Many families transfer their home into a trust, into a child's name, or into a limited liability company for estate planning reasons. Several of these transfers can quietly disqualify a senior from local property tax relief programs, from the homestead exemption, or from certain deferral programs. I'm about to share the most important insight of the entire video, but first, if you have gotten real value from this content, please do 3 things for me and for the seniors watching with you. Tap like, subscribe, and hit the notification bell. Then leave one short comment telling me your biggest takeaway, whether it is the $6,000 deduction, the income phase-out warning, the property tax deadline, or something else entirely. Now let us walk through the insights that contain the most actionable money-saving detail. Most senior homeowners, when they hear about a new federal deduction, quietly assume that some accountant or their tax software will simply claim it for them. That assumption is dangerous. According to current guidance from the Internal Revenue Service, taxpayers must affirmatively claim the new enhanced deduction for seniors on their return. It is not automatic. Tax software vendors are still updating their products to fully reflect the new law, and older versions of popular tax preparation programs may not yet include the new line. The result is that thousands of seniors who clearly qualify could finish their 2025 return without claiming the $6,000 deduction simply because a box was not checked, a line was not filled in, or the version of the software did not support the new form. The second critical insight is this. Property tax relief programs are usually administered at the local level, which means the senior next door in a county 1 mile away may have access to a completely different set of savings than you do. That is exactly why your comment sharing your location is so valuable. When you post your state and county in the comments, you help fellow viewers who live near you discover whether their area offers the same programs. Comments on videos like this quietly become a free research network that saves real money. The third critical insight is timing. The new senior deduction is effective for tax years 2025 through 2028 only. That is 4 years. Unless Congress extends or replaces it, it disappears after the 2028 tax year. For seniors on a fixed income, this means now is the time to plan around it, not later. The fourth critical insight is that the income thresholds treat Social Security differently than most people expect. Up to 85% of your Social Security benefits can be included in your modified adjusted gross income depending on your other income levels. So even a modest pension combined with a full Social Security benefit can quietly push a single senior surprisingly close to the $75,000 phase-out. The fifth critical insight is that scams will increase around this topic. Every time a major tax change hits the news, scam callers begin dialing seniors about verifying your new deduction or helping you apply for the senior freeze. The real Internal Revenue Service will never call you on the phone to ask for personal information. The real county assessor will never ask for your Social Security number over a pop-up phone call. You have stayed with me through a lot of important detail, and that tells me you take your retirement seriously. As we close out, do me one last favor. Like this video, subscribe to the channel, share it with at least one senior homeowner in your life, and drop one final comment with the words, "I am ready," if you plan to take action on at least one item from today's checklist. Your engagement is what carries this information to the next family that needs it. Here's the bottom line. The One Big Beautiful Bill Act, signed on July 4th, 2025, did introduce real, meaningful federal tax relief for seniors 65 and older in the form of a $6,000 deduction, and that is genuinely good news for those who qualify. But the same law also tightened several other tax credits, carried strict income phase-outs that quietly disqualify many hopeful homeowners, and put a 4-year expiration date on the benefit that makes long-term planning more urgent. On top of that, property tax relief programs at the state, county, and local level are layered on top of the federal rules, and most of those programs operate with summer filing deadlines, local income limits, and application requirements that change from one county to the next. The seniors who come out ahead are the seniors who act. They pull up their property tax bill, call their county assessor, check their projected income before year end, talk to a tax professional before signing a new contract or transferring a home title, and look at every line of their tax return before they file. The seniors who do nothing are the ones who quietly miss out on a deduction worth thousands of dollars, lose an exemption they could have claimed, or pay more than they should for home improvements because they relied on a tax credit that no longer applies. You now know the right questions to ask, the deadlines to track, and the traps to avoid. Please use that knowledge, protect your home, protect your benefits, and protect the retirement you worked a lifetime to build. I will see you in the next video with another update designed to keep you informed, prepared, and in control of your future.